Hi everyone, welcome. I'm Professor Becky Francis. I'm Director of the Institute of Education. And it's an absolute pleasure to be here today. I'm always really glad to be involved in the Centre's work because it's so world-leading and a real point of pride for the whole of UCL that we host it here. It's also my pleasure to introduce Lorraine Dearden to speak to you today. Lorraine is Professor of Economics and Social Statistics in the Department of Social Science, and she's also Head of Quantitative Social Science at the UCL Institute of Education. She's also a Research Fellow at the Institute of Fiscal Studies. Now, Lorraine's currently part of the leadership team in the new English Administrative Data Research Centre that's facilitating administrative data linkage across government departments in the UK, and she's involved in leading the research agenda for the Centre. Her particular interest is on linking the extensive English schools and higher education data to economic and health data in order to answer policy-relevant questions. And I think that really summarises some of Lorraine's interests and passions, because most of her recent research has utilised administrative data or administrative data linked to surveys. But she has long-standing interest in higher education research, and as you know, has published extensively on higher education funding issues, widening participation issues, as well as the returns to higher education. And actually reading her CV, it's so impressive because as well as this research strength, she has an extraordinary area of other interests, really extensive areas of prior research, ranging from the impact of education and training on labour market outcomes and company performance, to looked after children, ethnic inequality and discrimination, right on to intergenerational income and educational mobility. So I really think that that speaks to the diversity of her research, but also her research strengths. Lorraine, we're really looking forward to hearing from you.
Becky.
Thank you, Becky, for that very generous introduction. And thank you, Simon, for inviting me to give this keynote. I'm very honoured, but slightly surprised that an economist was asked to give a keynote speech to this conference. Actually, I don't know if Francis is still calling himself an economist, but 2 economists are giving keynote speeches at this conference. We are not usually very welcome because ours is the miserable science, and we are well known for being very boring and gloomy. When you go to a party as an economist, you always wait and hope that you never ask the question, the what do you do question, because you end up being on your own quite a lot of the time, very quickly. Or in a good scenario, you end up talking about interest rates for a while. And I'm sad to say I love talking about interest rates. So at parties, I'm a social researcher. But today, I'm going to own up to being an economist, and I'm not going to disappoint, because I am quite miserable and quite gloomy about some of the recent changes to higher education financing in the UK. Moreover, if you understand what I'm going to say today, you will be very unhappy by the end as well. So aren't you pleased I'm here? Okay, I'll give a quick outline of what I'm going to do. So I'm going to begin by giving you an economics lesson, just to get it off on the right foot. So a quick tour of the economics of higher education. Then I'm going to focus on 2 recent reforms. It says UK there, but they're basically English reforms that have been driven by the notion that we should be increasing competition to improve higher education in England. So I'm going to look at the 2002 fee reforms that happened, under when David Willits was higher education minister, and also the 2016 reforms which Joe Johnson has driven, which is allowing more private providers to enter the higher education market. Okay, and what I'm going to do is look at the economics behind these two reforms and show what I think, or I'll show what the outcome of the 2012 reforms were, and I'm going to predict the likely outcomes of the latest reforms. And the news is not good. And it's based on what I'm going to say is pretty bad pub economics. So I'm going to talk you through the economics of higher education. And there are very, very good economic reasons why the market alone cannot be allowed to operate in the higher education sector. And there's four key areas. There's credit market failure, there's externalities, which Simon has just talked about, there's lots of risk and uncertainty, and there's information problems, which all mean that there's very, very good reasons why you should not just let the market rip. Okay, I'm going to... credit market failures. To go to university requires students to have money, either to support themselves or to pay in countries where there's fees, and increasingly a lot of countries have fees. You need money to pay for fees. Now, if you had perfect credit markets, students would go along to the bank, say, you know, I'm going to university, I need a loan to pay my fees and support myself during the university, and I can, you know, I'm going to get all this human capital and then I can pay back the loan. Give me a loan. But banks will not do that. There's no collateral for them to rely on. They can't sort of say, okay, I'm going to take a stake in your brain, and if you fail to repay the loan, I'm going to, you know, sell your brain and get back my money. You can't. There's no collateral in human capital to secure against the debt. The credit market doesn't work. Also, there's asymmetric information, that the student has a lot more information than the bank about, you know, how hard they're going to work, their future career aspirations and stuff like that. Credit markets don't work properly. And it means that, what economists say, there's adverse selection and moral hazard problems, which mean that the banks will sensibly ration loans, insist on parents guaranteeing loans, which will mean that children from poor socioeconomic backgrounds won't get access to the loans, or, you know, there will be credit rationing, and most importantly, it will mean there will be insufficient lending for students and the optimal level of higher education to take place. There is a credit market failure, so we need government intervention. And I'll go back. Simon talked about this as well. There are well-known private returns to going to higher education. I mean, in the UK, the returns to going, you know, to higher education versus, you know, just getting A levels are in the order of sort of about 9 to 10% per year. You know, it's around a 30% advantage for those graduates. They're huge private returns. But as Simon said, there's lots of other social returns as well. And so individuals do not, when they're thinking about whether I should, you know, should I go to higher education or not, do not, you know, incorporate the social returns in making their investment decisions. So there are externalities, really important externalities, which means there's very, very good reasons for governments to subsidise higher education provision. There's lots of risk and uncertainty. So even if governments guarantee, you know, banks who are giving loans, there's risks and uncertainties, which means students may still be reluctant to borrow. You might say, oh, you know, I'm worried about getting a loan because what if I fail my degree? You know, how will I repay this loan? I'm not going to get the advantages. You know, I've said there's high private returns, but there's huge variability in these returns. And so, you know, that may affect an individual's decision to go to higher education. Students might have debt aversion. Claire's done a lot of research on this, which might affect their decision to go to university. And, you have to, a good system, a good loan system has to be able to insure against this risk and uncertainty. And so, again, you need government intervention. And finally, there's lots of information problems as well. To make rational decisions about whether to go to higher education or not, individuals need to know about what they're doing. I mean, I'm the mother of a 19-year-old son, trying to make university choices, what to study. It's very, very difficult. I entered university a long time ago and I was going to be a lawyer. I was definite that was the career for me. In Australia, where I'm from, if you want to do a law degree, they make you do a combined degree. So, I had the choice of a BA, a Bachelor of Economics, or a Bachelor of Science, and I went, eeny, meeny, miny, mo, I'll do economics. That was about the strength of my decision. And of course, within 6 months of starting my degree, I thought law was the most unacademic, boring subject ever, and I really loved economics and econometrics. So, it's an experience good. You really don't know whether your choice is good, and individuals need to be protected against that. And you don't know about living costs, you don't know, about debt repayments, and actually you don't know about all the other benefits which going to higher education might bring. Health, happiness, a better partner. There's lots of things which you can't potentially factor in. So, and all these factors affect not only whether an adult goes to university, but it also affects the aspirations of young people as well. So, lack of information is a big problem in the economics of higher education. So, all of these market failures and problems mean that there are very, very good, sound economic reasons for state intervention in higher education on purely efficiency grounds. So the externality problem means that the financial burden of higher education should be shared between the government and individuals. There's a question of how much, how much are the social returns versus the private returns, but there is there's no argument that there should be some sort of government subsidy of higher education. And the other market failures mean that student loans need to be guaranteed by government. You talk about the US being a very free market oriented higher education provider, but their student loans are government guaranteed, even if they're provided by banks. It's really important, I think, that loans have insurance against risk, and this is where we have the huge advantage in England. We have income contingent loans, which insure against this risk. In America and the US and other countries with mortgage-style loans, there's not that insurance. And it's also very important that we have transparency. The system is easy to understand. You have as much information for the student as possible about the benefits of a degree, the careers and stuff like that. There's lots of good things, good reasons why the government should be involved. But there also exists equity arguments, and I don't think we should underplay those. The efficiency arguments alone justify government intervention, but there are very, very important equity arguments for government intervention as well. And that is an important policy decision. How do we ensure that how do we ensure that those first generation higher education aspirants have easy access to higher education? So there's lots of good reasons for government intervention. So one important thing, and I've already mentioned it, is income contingent loans. And this is very, very important for getting around the credit market failures and the risk point. And they're loan repayments which are contingent on income. So you, in England or anybody who takes out a loan in the United Kingdom, they pay 9% of earnings above 21,000 until the loan is paid off, and it's written off after 30 years. Okay? And you're guaranteed that you never pay more than 9% of your income. And the only person paying 9% of their income is some very, very high earner. So it provides insurance against repayment hardship, and it avoids default. If you have bad luck and leave the labour market, and you're in an accident, you decide to you go off and have a child, you pay nothing for your student loan. If you do really well in the labour market and are earning lots of money, you pay off your student. You pay a much larger. Start paying off your student loan, and you pay off very quickly. So it insures against risk, and it means that there's no upfront cost to going to university, and then you pay back on the basis of how well you do in the labour market. Okay, so it's an important concept because it has really big implications for introducing competitive forces in higher education in this country. So what I argue is that it's bad, what I call, what is called sometimes pub economics. I'm stealing this term from Nicholas Barr from LSE, who uses this. So what he calls pub economics, which leads to bad policy design. So what is bad pub economics? One is that you always hear in the news that if you increase the minimum wage, then it's going to definitely result in unemployment. That is bad economics because it fails to understand the difference between shifts along the supply and demand curve and shifts of the supply and demand curve. It gets the answer wrong. There's other pub economics that if you reduce income tax, then you're going to have more productivity. People are going to work harder. That is bad pub economics because it fails to recognise that there's an income and substitution effect. So, what I'm going to argue is that a lot of the recent reforms in making the system more competitive is based on bad economics. And in the two examples I'm going to show, it actually makes the situation worse rather than better. So if you rely on very simple theory about the effects of competition, I think you're going to get the answer wrong. So how am I doing for time? Okay, that's fine. So my bad economics example one was the 2012 fee reform in England. I don't know if people know what happened, but in 2012, the government lifted the cap on fees from £3,000 to £12,000. And importantly, whereas every single course, because there was recognition that there's externalities and the government should provide subsidies for going to higher education, every course, whether it's arts, humanities, or science, got a direct government grant to subsidise teaching, presumably based on the recognition that there is some sort of externality. What the government did was reduce the direct funding for courses by 3,200 across the board, which meant that all arts and humanities subjects received no direct government funding for teaching. And to make this up, this cut of 3,200, it increased the cap on fees. And what the pub economics logic was, it would provide price competition. If you just wanted to get where you were, you would just have to charge a fee of around 6,200. That would be cost neutral for everybody. But some universities were saying that actually to provide undergraduate education, it costs more than that. So the government recognised that some, very, very few, but some would maybe charge, even the maximum 9,000. But Treasury, you think there's some good economists there, predicted that the average fee would be around £7,500, and with very few institutions charging £9,000. So what happened? The reality is that fee competition could never work in the English HE sector because we have government guaranteed income contingent loans for very, very good reasons. So, how did this affect students? Very unlikely to affect students at all. Not because all it means is that the student pays this income contingent loan for slightly longer. And in fact, as part of the 2012 reforms, they put up the threshold, and that meant for 30% of students, they would actually pay less. So all with an income contingent loan, a bigger debt just means you pay for a few years longer, and the maximum you can pay is for 30 years. So it's unlikely to have had an impact on students. But also, what is the incentive for universities? If they put up their fees to £9,000 and it's unlikely that students are going to change their behaviour, there's no risk for them, right? If they charge £9,000, what happens to them? What is the risk to them? They're not giving the loans. The government's guaranteeing the loans. There's absolutely no risk. So if the student drops out or they fail or they don't get a job after, there's no penalty for the university. So universities who are sensible and understand the system should just charge the maximum price. And what happened? So a few universities didn't go, so this is a very bad scale. It's going from 8,200 to 9,200. So you can see that the average was around 8,650 in the first year. And one of the universities that didn't charge the full £9,000 was the London School of Economics. They only charged £8,500. They corrected themselves the next year. And as you can see, by 2016, before the latest reforms, virtually every single university was charging the maximum. And, it's always the case because there is no risk. So, in 2017, the latest reforms, universities could increase their fees by the retail price index. So, so from 2017, they can be charged up to £9,250. And what happened? All but 2 of the largest 90 universities are charging the maximum. I had somebody over the summer go to every single offer agreement, and all but 2 are charging the maximum, and 1 is charging 9,246, so £4 below, because it's divisible by 8. They have 8 units and they charge for each. So if you want to update the graph, it goes up. Okay, and that is because, quite rightly, we have an income contingent loan, and pub economics does not work. And so, as I said, if graduates don't repay, what's the cost for universities? If graduates drop out, what's better, having a low fee or a big fee? It's better having a big fee and only getting, a quarter of it, a half. If you totally deregulate the, HE fees, then you would have prices approaching overseas students' fees, without doubt. And if it is the case that universities don't bear any of the risks of raising fees, they will always charge the maximum fee. Okay, so there's one more important point. As I said, before 2012, universities were surviving by having, for a basic course, around £6,250. So, and all of them have now raised their fees to £9,000. So it's highly likely that a significant proportion of universities are charging more than the cost of provision. And I think that raises huge ethical issues that, are, as I said, it's not just efficiency arguments that you should consider, but also ethical issues. And I think there's huge ethical issues with the current design of the English loan system. So what does good economics tell us? As I said, ICLs are necessary, but they mean that crucial aspects of standard economics no longer hold. And now you might think that income contingent loans are not, they were first implemented in Australia in 1989 by a slightly cuddly and left-of-centre economist, but with the name of Bruce, who's sitting in the audience over there, and maybe he wasn't one of the sort of classical economics. Well, that's just wrong. Income contingent loans were first mentioned by Milton Friedman in 1955. I mean, he was the one who first came up with the notion that you need an income contingent loan for the financing of higher education. So if you want to allow a range of fees, what is important is that the higher education institutions need to share some of the risk of non-repayment. And you've got to come up with a system which means that what university charges reflect the true costs and benefits of provision. So there's currently lots of economists now trying to work out how you can effectively design a system which ensures that universities have what's called skin in the game. They bear some of the consequences of what happens. So, you could argue that I'm sort of choosing an example where I know what the outcome was. So, I was cheating, sort of saying, I've looked at the data, I've seen that everybody's charged 9,000, and I've gone back and sort of tried to dream up some economics which explains it. But it's not the case. I mean, all the government had to do was look at New Zealand and what they did in the early 1990s. So New Zealand introduced an income contingent loan in 1992. They were the second country after Australia to do it. And very shortly after they introduced it, they allowed complete deregulation. So universities could charge what they liked and just let the market rip. And guess what happened? Fees soared by more than 300%, and the costs to government, because these are heavily subsidised loans, went out of control. There was student protest. It was a complete disaster, and they completely went back on it. There's international evidence that this wouldn't have worked before this reform does, and it was completely ignored. I think this is a huge problem in this whole area, the ethnocentricity of higher education policy design. People are very reluctant to look outside their own borders. And there's other options that you can do, if you can't divide, you can cap student numbers, you can... Part of the problem in England is that, there's very, very generous upfront support for students going to higher education, but not to vocational education. Up until recently, there was very generous support for full-time study, but not part-time study. So you need to make sure that the ground is neutral so that students are also choosing optimal paths. I think in the current system, a lot of students are choosing higher education routes who would be better in the vocational sector. And again, it's through bad policy design. Okay, so that's my example of bad economics 1. So I'm taking a bit more of a risk here now, because this is a new policy which is just being introduced, which is freeing up access for private providers. So Joe Johnson is, saying we're going to add more competition. Get the old dinosaur universities need a shake-up. So he's going to allow private providers to enter the market and charge up to $6,200 per year in fees. And so the argument will provide much needed competition in the higher education sector and improve choices around provision, part-time provision, fast-track provision. The universities just are so staid, they just offer the same sort of staple. Break the university's stranglehold over degree awarding powers and verification, which because private providers could enter the market already as long as they got a university sponsor, but this was outrageous, and it would improve choices and outcomes for students. So here's some of the quotes from Joe Johnson. I love this. "We will strip existing universities of the power to act like bouncers, deciding who should and should not be let into the club, and it will help high-quality providers tap unmet demand for different ways of learning." And he cited the example of what he went back to the 1820s and saying, universities are always saying, the established universities are always saying this. In the 1820s, UCL, now a pillar of academic excellence, was dismissed as a Cockney university. So there you go. Universities have been playing the same game all along. But the economic reality is that whilst it may allow some high-quality providers to enter the market, they could have done that before. There was sort of established paths. This idea that the lack of choice of provision, being able to do a degree quickly or do a part-time degree, wasn't driven by universities, being stuck in the mud. It was driven by the financing systems which incentivised universities. You could only get a £9,000 fee loan if you do an accelerated course. You've got to drastically reduce costs. There was no income contingent loan for part-time students, hence why part-time student numbers fell. It was driven by the design of the loan system. It wasn't driven by the fact that universities didn't want to have varied provision. And what, in this example, we haven't yet seen what's going to happen in the United Kingdom, but the experience from Australia, New Zealand and the US tells us that this reform will end up costing the government lots of money with little, very little, or maybe no benefit to the students, as regulation of this free market is very difficult. And again, it's especially because of government-guaranteed student loans. So let's look at the US for-profit sector. The for-profit sector in the US surged during the weak labour market following the job market following the 2008 recession. And so college became an appealing alternative, but state revenues were, states provided subsidised college education, and the decreases in funding meant it was unable to fund this increased demand. But also the government provided much more generous loans, tax credits, Pell grants. So it had some much more generous benefits for those who decided to enter higher education. And it saw the enrolments by private providers rise. So the growth rates jumped by 21.5% from 2007 to 2008 alone. So you could argue this is a good news story, right? No. Because basically what has happened, and this is very well documented, and there's other CGE research documenting this, is that millions of students have left for-profit colleges with few skills but major debts, and their financial lives ruined. Now, they don't have income contingent loans, but they have government guaranteed mortgage loans. So there's no risk to the private provider. They know the students can get the Pell Grants and the loan. They get the money through the door. Then there's no incentive for them to provide a good degree because they get the money up front and at no cost and no risk. So defaults in the US system are concentrated in these for-profits and the community colleges. But the largest increase in default rates is in the in-profit sector. So this is data from Looney and Yanis, the paper, and you can see that for the 2000 cohort there was 18% defaults, and for the 2010 cohort 28%. Now the myth in the US is that all the defaulters are have got $120,000 loans and are defaulting. That is completely wrong. The concentration of defaulters is the biggest defaulters are with the lowest loans. So the biggest default rate is amongst those in the US with loans of between $1,000 and $5,000. And they're at for-profit organisations. But so the US is one system, they've got a mortgage-style loan, but you could go back to New Zealand again. In the early 1990s, New Zealand government also introduced uncapped places and unfettered private provider student access for government loans, and it was done for exactly the same reasons as advocated by Joe Johnson, widening access to higher education, giving greater choice to students, and responding to the need for more graduates in the knowledge economy. And perhaps unsurprisingly, participation rates soared, fees soared, and government expenses just, were unsustainable. And the government completely changed its mind and wound back the policy. I could give you another example in Australia, where they allowed private providers to enter the vocational sector, access income contingent loans, and there's a wonderful report. You had private providers turning up at nursing homes, offering these people iPads, saying, register on our course, we'll give you a free iPad, take out these loans, you're never going to have to repay them because you're retired, and it's a win-win situation, and they just pocketed the money. It was cost, how much, Bruce? $2 billion. I mean, it's just wait and see what happens here. Okay, so I'm going to close up now. I've got lots of other things I could whinge about, which shouldn't be there for good economics, like the real interest rate on the current income contingent loan is way too high and, in fact, regressive. The abolition of grants that came in last year, absolutely stupid policy, which is based on no evidence. Grants are absolutely an essential part of a good student finance system and very important for access. The hefty funding that happened in 2012, the fact that arts and humanities get no direct government funding is bad. Are you really saying there's no externalities to humanities and arts education? It means that actually you're seeing quite a big reduction in the provision of those courses. And there's very poor information on the value of different degrees. There's a survey of all graduates, which follows up graduates after 6 months and 3 years. And that's meant to tell you how good your degree is. It's shocking and it's not very good information. But new data could potentially help here. So there's lots of other bad things in the system, which I won't go into. So I'm going to finish now, but I think my message is beware of simple economics being used in a complex higher education world. And it is a complex higher education world for very, very good and sound economic reasons. But it does mean it's very difficult to have price and provider competition in the HE market. And we shouldn't pretend that it's anything. There is no, you can't have proper competition in the HE world. And so you need to go beyond pub economics to design effective higher education policy. Okay, so I'm going to end the misery now and answer questions.
Wonderful, thank you, Lorraine, and that's a warning to us all about pub economics, and I'll certainly be on the lookout from now on. It's really great ammunition, actually, and a really helpful overview of the current state of play in university funding. Lots of questions coming out of that, I'm sure. Can we literally have a show of hands? If you have questions you'd like to ask, I'll take them in a couple of clusters at a time. So just challenging for the people with mics. We've got each at far sides of the room. Thank you.
Okay, so Rosemary Dean, Royal Holloway, University of London. I mean, I think that's a really, really good analysis, Lorraine, and I think it's a very important set of arguments that you've put forward. But I had a couple of questions about the first example. In relation to your argument that universities should share some of the cost of the loans defaulting, because I think that is maybe where we're heading, particularly in terms of the teaching excellence framework, because one of the arguments is that when they look at the data from tax records for graduates, they will be able to tell who is earning what, and there's a kind of implication that if your students are not earning lots of money, that actually it's the fault of the teaching. I don't quite see the connection, because we have 50 years of research which show that the kind of job you get is related to your gender, your social class, and possibly the discipline, but certainly not the teaching. So I think that that's quite a worrying direction, because it's actually difficult to see how universities will be in a position to kind of cope with the defaulting of these loans, because most of them don't have that kind of money. Obviously the for-profits might, but I'm sure they'll be quite good at wriggling out of it. There was also something you didn't mention in relation to, you talked about losing the maintenance grant. I agree, that was a crazy decision. But also the extension of the student loans company to part-time degrees hasn't necessarily had the effect that it might have had. For example, the Open University has found it extremely difficult to cope with, because the cost of its degrees has gone up massively, and so they're hemorrhaging students. So it hasn't necessarily helped part-time students that much.
Thank you very much, and we had one at the far side here.
Thank you. I'm Rob Stride. I'm the head of alternative provider engagement at HEFGE. In relation to your first example, you spoke particularly about universities. I think as a point, it's worth noting that there are obviously also around 200, 250 further education colleges delivering higher education, and often at a lower price than the £9,000 maximum fee cap. But of course, it's also important to note that we in this country at the moment have over 100 private providers offering higher education and accessing the student loan system. And so my question in relation to them is, well, for them the loan is capped, but the fee is not. And indeed, you know, we see fee levels ranging from below £6,000 to over £20,000. So my question there is that a better system? And whilst I've still got the microphone, I'm going to be cheeky and shoehorn in a second question. In relation to your second example, you stated that regulation of private providers coming into the sector is difficult. My question on that is simply, why? There's been no suggestion that access to the loan system will be an unfettered access to the system, and indeed there are some quite significant barriers to entry at the moment to come into the system. And do you feel that we should perhaps have some confidence in our regulatory bodies in the future?
Thank you. Wow. I should say, I was going to say 2 stimulating questions, but actually 4 stimulating questions. Thank you, Rosemary and Rob. Lorraine.
Yeah, I mean, Rosemary's question about, you know, worrying about the government using tax records to sort of see how much students pay back. I think that is a worrying way of doing it, because actually to do that properly, right, you're going to have to go back. You want to see what the students earn in the next 30 years, okay? The only way we could do that, currently I've got access to the student loan data linked to tax records. I'm one of the few researchers that do. We could only do it at the moment for the cohort born who went to university in 1998, they graduated in 2002, and we've got about 10 or 12 years earnings data from them. We could, you know, look by university how much people have repaid. But is that an accurate reflection of universities today and how they're performing? No. So the only way you can make the system work, I think, and you know, it's very hard, is by universities up front. But there being some trade-off between how much money they get direct from the government to subsidise that, and if they want to charge higher loans, they don't get the full value of that charge. You tax them as they're making the decision. And actually, Lord Brown, when he did the original 2012 reform, suggested that very much. He said you should be allowed to charge up to 2012, to fees of up to £12,000. If you charge £6,000, you've got the full £6,000. If you charge $7,500, you're taxed, I don't know, 20%, so you only got 80 of every 100 extra pounds you charge, and then the tax rate, I think, went up to 75% if you went went up to 12 housing. So there's ways of trading it off, and universities making a decision, the trade-off between getting a direct grant and at the same time they withdrew the direct government funding for reasons. So I think there are ways of doing it. But it does require a lot of thought, and as I said, there's lots of people thinking about this area at the moment, and there might be people in this room who have got a way of doing it. But you know, it's a problem that has to be solved in an equitable and fair way, and you know, you'd hate it to be based on things like gender, because on average women spend more time out in the labour market, and if the university is going to be penalised, then they might actually, you know, unconsciously not want to take on female students. So there's huge issues, incentive issues there. The abolition of grants, crazy policy, which saves the government very, very little money. And you know, we've got very, very strong, robust evidence. I did a paper on the grants were reintroduced in 2005 when nothing else changed, and it had a big impact on the proportion of low-income students attending university. But part of the reason for the change is that grants go to account against public sector net borrowing and look bad for the government, whereas loans can, you know, are treated differently. So it makes other things, there's sort of good government accounting reasons why they always prefer to have loans and grants. It saves the government very little money because a lot of poor students weren't going to pay off their loan anyway under the old system, and now they've got the biggest loans, they're not going to pay off their loan anyway. It makes absolutely no difference to government revenue for around, you know, 70 to 80% of students, so it saves very little money. And particularly, I think there's emerging evidence, we'll see it may have impacted on participation of poor students in the last year since its abolition.
Lorraine, can I just interrupt you just before you go on to answer Rob's questions? It might be better, actually, I think, if you come back to if you don't mind coming back to the podium. We're having problems with your mic, I believe. Let's hope this one works. Sorry about that.
And part-time students, you know, the income contingent loans for part-time students, I'm not sure of what, you know, maybe it's just not that they're not visible, people don't know about them. You're saying that they don't cover the full cost for the Open University, I don't know. But I mean, having the part-time versus full-time option should make choices easier. Clearly, you're saying it doesn't. I haven't looked at that question, but I can't explain why not. So private providers, yes. I mean, what I'm saying, okay, I think there's an important role for private providers. I think at the moment, is it such a barrier that they have to sort of team up with an established university and go through verification till they prove themselves? I don't know, it seemed like the regulation that was happening at the moment sort of worked and it was under control. I am really, really worried that I know they've set up a new regulatory body, what is it called? The Office for Students. I think there's it's going to regulate all universities. It can sort of say that, you know, established universities, you know, can't do it. I just think in this short time period and the incentives that exist in the system, there is going to be some unscrupulous private providers that are going to take advantage of the system. And you know, maybe the regulation is all in place and it will work brilliantly. My gut instinct, based on what's happened before in Australia, in the US, they've got a regulatory body for private providers, and I think it's being disbanded at the moment. So you know, maybe we're going to be the exception and there's going to be good regulation that will all be fine, but my gut instinct is that something will go wrong and costs will skyrocket. So you know, maybe that's not a satisfactory answer for you, but based on what's happened before in the US, in Australia, in New Zealand, I am very worried. Okay.
Thank you. More questions? So we've got one here, gentleman here, and a gentleman at the back.
Thank you. John Hearn, Worldwide Universities Network. Can I ask, to what extent are the economics around international students postponing the realities of domestic students? And if I could add a second.
So, sorry.
To what that's a wonderful framework, focusing on domestic students and two main domestic policies. To what extent is the huge additional costs charged to international students postponing realities domestically while exploiting international students, their parents and grandparents, and their lives and debt a great deal more than domestic students?
Right, yeah.
And if I may be permitted a rider.
Well, if it's a very, very quick one,
It's very quick.
We need quick returns, I'm afraid.
Yep.
We had my organisation had a Brexit workshop in Brussels 2 weeks ago, and we went over a number of the arguments. And Tim King, the journalist, said, "You guys are so polite, you academics, government, sitting around diagnosing. You say that you controlled 80% plus of the academic vote to remain, but you lost. You're losers. What are you going to do about it?"
Thank you very much. And the question on this side.
Yes, thank you. Doctoral researcher from the University of York Management School. I wonder if, following about the international students and the fees that they pay, there has been some private providers in some other countries that they usually tend to do partnerships with existing institutions in order to legitimize their relevance and try to position themselves in order to gain advantage and try to be much to gain advantage in markets such as in the UK or in other countries. So I was just wondering, in your point of view, what is going to happen then in the UK with alternative providers or new for-profit institutions coming into the UK? Do you think that they will attract domestic students from disadvantaged or rural areas, or will be just focusing on attracting more international students, perhaps through partnerships or online degrees?
Thank you.
I think that's an interesting question about international students, and it's going to become more pertinent with Brexit, because currently any EU student who does a degree in the UK can get an income contingent loan for fees. Okay, and that will stop, presumably, when we go through Brexit. They will now be international students, and even if there's some deal over fees, they will not have access to income contingent loans. But I don't know how you solve the international student problem, because it's a really important market, okay? International students paying these big fees, and presumably, they rely on support from their country. A lot might have scholarships from their country. They might take loans in their country, which are almost certainly not income contingent loans. So, yeah, it's a problem. I don't know the solution. It seems to me that I don't think it's a problem that we can solve in the UK, but increasingly, a lot more countries are recognising the problem of student loans, and in particular mortgage-style loans, and moving to income contingent loans. Bruce this afternoon is going to sort of talk about the problems with this, but I can't solve your problem, I'm afraid. And I think it's going to be increasingly pertinent with Brexit. because at the moment European students can get income contingent loans. I'm just trying to, the second question, again, I'm not an expert on this. I can't. So you're sort of saying that there's lots of private providers. I don't have a lot to say on your question, I'm afraid. It's just beyond my expertise. But you know, and I'm just acting more on a hunch of what's happened throughout the rest of the world. I mean, you know, let's see what happens. But I'm making a prediction that I think there's going to be an explosion of alternative providers. I'm not confident that a regulation will be able to control it, and there could be huge implications for costs. So, warming out of it.
Thank you very much for your questions, and to Lorraine. I mean, that's been hugely stimulating, and I think impressionistically, some of the issues that have been coming out for me are the questions about ethics. You know, what are we doing as universities? What is our nature? What is our work? And of course, increasingly, what is our business? What are the ethics of demanding, greater returns, for example, from international students, or indeed charging above the cost of a course, perhaps to go into university reserves and so on and so forth? These are really genuine, challenging questions, aren't they, that speak to the changing model which we're being asked to undergo, and I'm sure will provoke stimulating talk and discussion over coffee as well as for the rest of the day. Thank you so much for that, Lorraine. You've given us enormous food for thought. Thank you.